So sticking on that topic of, market trends, give us a brief overview of where we are currently in the market, right? Like what would have happened in the past 3 years? We had COVID, things were up, things were down. What happened and where are we right now?
So a lot happened.
Understatement of the year.
So let me take us back to March of 2020. The buzz around the Transjam IPO and then the fear of COVID. We had the lockdowns and then persons were really uncertain about what is happening, what's going on. So you had an asset sell-off. Persons are, selling their stocks because they want to keep as much cash as they can, or they want to buy all of the tissue paper to the supermarket because they don't know when lockdown is going to end. So we had an asset sell-off that created a unique opportunity for persons to invest, as I said earlier, buy low, sell high, to invest in those quality companies that they see will be able to, withstand whatever pressures COVID might carry. So we had a rebound in the stock market in 2021, and then something which probably hasn't happened in a very long while happened in the latter half of 2021, where it seemed as if the economy was overheating because of all the money that was circulating in the economy, both locally and abroad. Whether this was just because of persons coming out of lockdown and spending more, or the different stimulus packages which locally and abroad would have been implemented, there was a lot of money floating around chasing too few goods. So that led to inflation, which persons were saying, "Oh, it's just gonna pass through. It's not persistent. It's just transitory." Where we faced a situation in which we did not fully quantify the risk to persistent inflation. So some central banks moved really quickly. Some central banks or monetary authorities move slowly. So the BOJ, our central bank, moved really quickly to start increasing the benchmark policy rate. And what the benchmark policy rate is, it's the rate at which the BOJ would set where banks borrow and lend money. So with the benchmark policy rate being increased, that's a signal to the market that, hey, there is an extra reward for keeping a little bit of money in reserve. It's a form of moral suasion where they try to signal to the market that, hey, we're realizing that, things are getting out of control. So inflation was above the band that the BOJ set of 46%. So they increased the policy rate to try and have fewer amounts of money floating around in the economy. So this adversely affected the stock market. So the stock market get a beating again. So increasing interest rates, so interest-bearing products that the Bank of Jamaica offers, like their CDs, those products started bearing a higher rate of interest, forcing persons to save more than they spend, to invest more than they spend. So these assets that the BOJ tend to offer, they're sometimes seen as substitute for stocks. So if I can get a 6% CD from the BOJ,
CD being a certificate of deposit.
A 30-day, 6% 30-day certificate of deposit, I'm going to take that guaranteed money rather than put it on a stock which would have a longer return horizon. So it's that phenomena that we would have experienced and that we're still currently experiencing, because rates are still elevated because we're not fully out of the woods yet. So the stock market would have slowed a bit. It rebounded in 2021, but slowed a bit in 2022 and would have been flat. In 2023, off the back of COVID, high interest rates and economic uncertainty.
Wow. So, we mentioned, we're kind of on the tail end of what we hope this economic uncertainty is. But as an investor, again, putting myself in investor shoes, 2019, I don't think any of us saw COVID coming. Not many people did. What could I have been doing as a regular part of my investment strategy that would have protected my investments, right? Because I mean, mainly, let's say, my portfolio tends to be a bit heavier on the stocks, right? I would have taken a significant loss during the past 3 years when the stock market was down. What could I have been doing prior to COVID that would have kind of protected my investments or protected my money?
A couple of things, and what I want to emphasize and start with is defining your goal clearly. Why am I investing? What do I want? Am I investing to get rich tomorrow? Am I investing for the tuition of my siblings? Am I investing for the tuition of my child? Define your goal clearly.
Right.
And out of that clearly defined goal, it's easier to have an investment strategy. And most of us, I would say, would probably, I don't want to speak for everybody, but most of us would be investing to have this thing about, generational wealth.
Yes.
So investing for wealth accumulation. So what you could have done as an investor is, 1, clearly define your goals. 2, do your research and speak with the professionals. So you can speak with the professionals, but I encourage you to do your research as well. 3, invest in quality companies or quality investment products. And 4, and what I'm going to encourage persons to do, is stay invested. The market isn't a short game. It isn't invest today, rich tomorrow. It's stay invested and achieving your investment goals.
Kirk, thanks. You just made a very important point there, which was staying invested in the long term. I know sometimes investors can get anxious, right? Like putting myself in an investor's shoes. Maybe I would have been investing in stocks prior to COVID. COVID happened. I don't have a particularly, strong background in finance, but I'm thinking to myself, a lot seems to be happening in the market. It seems like stocks may take a turn. The stock market may go down. So I decide to liquidate my stocks and put my money in my bank account, my savings account, right? You just mentioned policy interest rates go up. So I'm expecting to see a little bump in my savings account. If I were to have left my money alone, left it in my bank account for, the next 3-5 years, how would that compare to if I had invested my money in one of Barita's unit trust funds or in one of our funds that gives me exposure to alternative investments? What would that have looked like in the long term?
All right, so those are some very strong and great points. And I know investors are worried and they're concerned about what happens next. What should I do next? And we are telling our investors to stay invested. So what we actually did, just to show to our investors how strong of a strategy it is to stay invested, is we did an analysis where, an investor throughout the troubling times about a decade ago, what would your returns have looked like had you stayed invested versus, your deposit monthly into your savings account? So, over the past 10 years, we would have experienced stuff such as the JDX, the NDX, which is Jamaica Debt Exchange and the National Debt Exchange, which are 2 significant financial events, which would have had ripple effects for the financial markets, whether it is there's some amount of financial uncertainty about what would happen after NDX and JDX. There would have been periods of some amount of turbulence in inflation, as well as fluctuation in the benchmark policy rates. So that was a period of a lot of economic uncertainty, just like now is. And what we realized, if you were to, put all your money in your savings account across that horizon, versus if you were to put your money in the Barita money market fund and the cap growth fund, over the period, what we realize is that you would have significantly outperformed any returns that you would have generated from your savings account if you were to take the approach of staying invested and investing in the Barita cap growth and money market fund over the long period. So those returns would have outpaced what you could have earned in the savings account. And that approach of staying invested, I believe, may serve investors very well for the coming times.
Thanks, Kirk. And I think it's very important because I know investors tend to get nervous when things in the market or the economy change, right? Everybody wants their money to be making the most for them. So
everybody wants to make $1 from 10 cents.
Yeah, right. So when we see things happening in the market, we tend to want to move to something that we think is safer. But what you're saying now is that if we have our money in one of Barita's funds, the money market fund or the cap growth fund, when we see things changing in the market, that may not be the best time to move. It may be best to just keep the money where it's at, in these funds, and look at it later down the line after things have evened out a bit.
Yeah, man. So despite the turbulence, despite the uncertainty, remember your goal and stay invested for the long term.
Okay. Well, we're gonna work